In the world of finance, there is a dangerous obsession with every word that comes out of Jerome Powell's mouth. Investors treat a Fed press conference like a trailer for a blockbuster movie, believing that the Fed's interest rate dial controls the entire universe. But there is a massive systemic misunderstanding of how the plumbing of the global economy actually works. The Federal Reserve controls the federal funds rate. This is the short-term or overnight rate. It is the rate at which banks lend to each other for 24 hours. While this is important, it is not the backbone of the economy. The real backbone is the long end of the yield curve, the 10-year, 20-year, and 30-year Treasury yields. As legendary investor Ray Dalio points out, these long-term bonds are the risk-free basis for all asset returns. Here is the catch. The Fed's influence, indirect and limited. The market's influence, absolute. Long-term rates are driven by supply and demand. If the United States is running trillion-dollar deficits and needs to sell massive amounts of debt, but its largest buyer, Japan, is pulling back, the supply of debt explodes while demand collapses. The result? Long-term yields must rise to attract new buyers, regardless of what Jerome Powell says about short-term rates. This explains the mystery of 2024 and 2026. Why do mortgage rates stay at 6 to 7% even when the Fed talks about cutting rates? The anchor. Mortgage rates are not anchored to the Fed's overnight rate. They are anchored to the 10-year Treasury yield. The stagnation. If global demand for treasuries weakens because of the Japanese repatriation, the 10-year yield stays pinned at a high level. The consequence? Home affordability remains strained, refinancing activity dies, and the housing market stays in a state of frozen transactions. The Fed can cut the short rate all they want, but if the long rate doesn't cooperate, your monthly mortgage payment isn't going anywhere. It isn't just houses, it's the entire corporate world. In 2020-2021, capital was on sale at 90% off. Companies issued debt like it was Black Friday, fueling massive expansion and high stock valuations. But as the yen carry trade unwinds, that cheap liquidity, the oxygen of the market, is being sucked out of the room. When long-term borrowing costs stay elevated, valuations compress. Analysts use long-term yields to discount future cash flows. Higher yields equal lower stock prices, even if earnings stay the same. Risk appetite falls. Investors stop chasing growth and start hoarding cash. Growth slows. Companies stop hiring and stop expanding because the price of money has permanently changed.